history would tell us that gold will start to outperform going into next year, particularly if we have peaked when it comes to risk assets. Is that the base case that you're going with if we follow this path of normalization at the Fed?
I think, actually the accelerated tightening coming from the Fed is probably, if anything, even given the inflation outlook, a bit of a headwind for gold. So I think there's two elements that we really think that gold may well do well in the current environment. Firstly, obviously, we do think that the dollar ultimately will peak as US exceptionalism comes to pass. So obviously, everybody at the moment is very focused on the strength of the US economy and to some degree, at least in the emerging world, weakness elsewhere. But we expect that to reverse at some point next year. So that's probably going to be a weaker dollar would ultimately be a tailwind for gold. The other reason to have gold as an overweight is that we believe that we're going to see greater volatility and more modest equity returns. So still outperforming. So therefore, from a portfolio construction perspective, having a bit of gold, which generally does well in extreme moves of equities, up or down, then you can get quite a significant benefit from a portfolio construction perspective. So that's why we're overweight gold today.
We see emerging markets ETFs rallying off their lows after the Fed decision. It's not typically a reaction that you see across EMs. Do you see opportunities in that space, or is your preference still for developed markets like the US and Europe?
So I think, obviously what happened last night was that basically Powell delivered on what he signaled previously, right? So what he delivered was pretty much in line with expectations, and you can see that from the market reaction in most places. So for us, that doesn't really change the outlook imminently. If you look at the Asia ex-Japan MSCI index, for instance, that's bouncing around key support levels as we speak. So I think the next few days are going to be pretty important as far as Asia is concerned. So we currently have a bias towards the US and Euro area as far as equity markets are concerned. So we're overweight those. We're neutral Asia ex-Japan. But if we get greater signs that dollar peaking is coming through, and we continue to see earnings revisions and economic revisions being positive, that could change our stance as we move through 2022. But for now, we still favor DM over EM.
Other than monetary policy changes, what are some of the other themes that you're watching across Asia? Because, of course, we continue to talk about potentially more geopolitical tensions between the U.S. and China, not to mention the tech crackdown, property sector slowdown in China as well.
Yeah, so I suppose, the common prosperity theme in China is obviously a key thing that we're very focused on in terms of saying, okay, the rules seem to be rewritten. I mean, overall, this common prosperity policy has been mentioned for decades and obviously, been a policy headline since 2012, but we seem to see more policies moving in that direction. So we're not, in terms of China, we're not excessively bullish on China at the macro level. We do expect economic growth to decelerate next year. But we do see pockets of interest in terms of areas where we think the government's going to be more supportive of. So obviously technology, hard manufacturing, and areas like climate change. So those are areas that we think the government's going to double down on and try and make sure that they move towards greater self-sufficiency and a cleaner, greener world. So from that perspective, we think that's a very interesting space to be playing in now.
Steve, with the ongoing slowdown in the property sector in China, not to mention the increased normalization that we're going to see in 2022 around the world, where does that put Asia dollar bonds?
So so we do, within the bond space, Asia dollar bonds actually ranks number one. So we have two overweights in the bond space, DM high yield being the other one. But in Asia, we believe that a lot of the bad news is already priced in. So obviously we keep getting bad news coming through, and we had some overnight in China in the high yield segment. So that's not unlikely, that's likely to continue. I think we're still going to get those that negative news flow coming through, the focus on the property property sector is going to be there. But we believe, that's pretty much priced in now. So we see the yields on offer at Asia level as a whole, for an 80% investment grade space. The yields are very attractive. But even in the high yield space itself, we think that's actually attractive as well. So, and that's attractive whether you look at relative to history on its own basis or relative to US IG in high yield. So yeah, it's one of the few areas in the bond space that actually looks pretty attractive today.